Here's a sentence you've probably heard more than once, maybe from a coworker, maybe from a podcast, maybe from a well-meaning parent sitting across from you at Thanksgiving saying, "Don't worry about it." The stock market always goes up, and that sentence carries more weight than most people realize. The U.S. stock market, measured by the S&P 500 with dividends reinvested, has delivered roughly 10% per year in nominal returns since 1928. That is nearly a century of primary data, and the claim has real weight behind it. But almost nobody who says it can tell you why. And that gap is where most investors get into trouble. The gap between the conclusion and the reasoning is where most ordinary investors quietly make decisions they'll spend years undoing. Because always is doing an enormous amount of work in that sentence, more than most people stop to consider. And when you actually look at the math, not the bumper sticker version, but the real mechanics underneath, something interesting happens. The case for long-term investing gets stronger, and the conditions under which it can fail become a lot clearer. Both things happen at once, and that's what we're going to work through today. Let's start with the surface of the claim, because it's worth taking seriously before we complicate it. If you had put money into a broadly diversified U.S. stock index fund at virtually any point in the last century, history suggests you would have done well. Not because every year was good, since most years aren't close to average, but because the long-run trajectory has been persistently upward. That's not a marketing slogan, it's the documented historical record, and it deserves to be treated as such. The S&P 500, which tracks 500 of the largest publicly traded companies in the United States, has delivered positive annual returns in roughly 73 out of every 100 years since 1928. That data comes from research compiled by Aswath Damodaran at NYU's Stern School of Business, and 73% of years ending in green is not a coin flip. That's a structure with a thumb on the scale, and understanding why that thumb exists changes everything. So where does the misunderstanding come from, and why does it matter so much for everyday investors? It comes from treating this as a simple fact about markets, rather than a conditional truth about time horizons, diversification, and how a reconstituting index actually works. Strip out any one of those conditions, and the statement starts to fall apart in ways that matter quite a lot. The intuitive version of the market always goes up usually goes something like this, and it feels logical at first. Markets reflect the economy grows over time, and therefore markets grow over time, which sounds clean and reasonable.
And there's something real in it, because U.S. real GDP has expanded over decades through population growth, technological innovation, and productivity gains.
The Federal Reserve's own long-run projections consistently reflect this view of positive structural growth in the American economy. More output means more revenue. More revenue over time means more earnings, and earnings are what give stocks their fundamental value. The McKinsey Global Institute put together a detailed analysis of S&P 500 returns covering several decades of modern data. Their finding was that nominal returns averaged around 9% annually over that period, roughly in line with the longer historical average. Inflation-adjusted returns came in near 7%, consistent with what equity historians have observed going back much further in time. That real return figure, 6 to 7% after inflation, shows up repeatedly across different researchers using different methodologies. And then there's the compounding argument, which is where most financial content stops, but it's genuinely important to understand. Take a dollar invested at 7% real annually, and after 10 years, it's roughly doubled in purchasing power. After 20 years, it's close to 4 times your original investment, and after 30 years, you're somewhere around 8 times your original purchasing power. That math is real, and it's one of the most important concepts in personal finance, which is why it gets repeated so often. So the popular version of the claim isn't wrong in the way that a bad tip about a penny stock is wrong.
It's pointing at a real historical pattern and real structural forces, and that distinction matters before we get into the complications. The problem is that the popular version treats those forces as automatic, inevitable, and unconditional, and they are none of those things. Here's the part most people skip, and it's the part that actually explains how the math holds together over time. The market didn't produce a smooth 10% per year. It produced an average of 10% across a period with some brutal years. It included 1931, when the market fell nearly 44% in a single calendar year, which is a number worth sitting with. It included 2008, when the S&P 500 lost about 37% of its value in 1 year. It included 2000 through 2002, a 3-year stretch where the market dropped by nearly half from peak to trough. The average feels calm, and the actual experience was not calm. And that gap between the two is where behavior determines outcomes. This matters more than people acknowledge, because the math of losses is not symmetric with the math of gains, and that asymmetry is critical. If your portfolio falls 50%, you don't need a 50% gain to get back to where you started. You need a 100% gain. A 40% loss requires a 67% gain to recover, and the hole is always deeper than the drop. That asymmetry is baked into the arithmetic, and it's why the sequence of returns, not just the average, determines what actually happens to your money. Now, here's the structural piece that changes how you should think about the whole thing, and it's the most underappreciated part of index investing. The S&P 500 is not a fixed list of 500 companies that have all somehow survived and thrived since the beginning. It's a reconstituting index, meaning companies that shrink, fail, or lose relevance get removed and replaced by companies that are growing. Eastman Kodak went into the index and eventually came out, and so did Sears, and so did Lehman Brothers in its own way. The index is not a monument to the past. It's a living filter that continuously updates toward companies with market value and momentum. That reconstituting property is one of the most underappreciated features of index investing, and it's a structural upward bias that individual stocks simply don't have. You can own an S&P 500 index fund and watch one of its holdings go to zero, and it barely registers. That holding is simultaneously being replaced by something else, and no individual stock has that property built into it. Enron didn't reconstitute, and Lehman Brothers didn't reconstitute, and if you owned those companies believing it always goes up, you lost everything. So the real claim isn't that markets always go up, it's something more specific and more interesting than that. The real claim is that a diversified, continuously reconstituted index of the largest companies in the most productive major economy has historically trended upward. And that's only true when dividends are reinvested, and the investor doesn't panic and sell at the bottom, which is a meaningful condition. That's a much more specific sentence, and every word in it is doing real work that the bumper sticker version leaves out entirely. Damodaran's data also gives us another piece of the mechanism that gets overlooked, which is corporate earnings growth over the long run. S&P 500 companies grew their earnings at roughly 6.5% annually between 2000 and 2024. The return on equity for those companies averaged around 16% over that same period, well above their cost of capital. That's not a trivial fact, because it means these companies, in aggregate, were genuinely creating economic value year after year, not just inflating on paper. When a business consistently earns more than it costs to run, and that earnings power compounds over decades, the stock price reflecting that value tends to follow. The third force is the one most people mention, but few actually internalize, and that's the role of reinvested dividends over time. A stock index that reinvests dividends performs dramatically differently than one that doesn't, and the difference over a 30-year horizon is substantial.
Most of what people call the magic of long-term investing is really just the relentless arithmetic of reinvestment compounding back into the portfolio year after year.
Let's put this into a simple illustrative scenario. And be clear up front that this is a model and not a prediction or a guarantee. Assume a nominal annual return of approximately 10%, which is consistent with the long-run U.S. historical average from the Damodaran dataset. Assume inflation of roughly 3% annually, which is close to the historical average over the same period, giving you a real return of around 7%. Assume no taxes and no fees for simplicity, but note that reality involves both, and even a low-cost index fund carries a small expense ratio. A taxable account also involves annual tax drag on dividends and eventual capital gains taxes, and any real financial plan should account for those factors. Under those assumptions, $1 invested today becomes roughly $2 in real terms after about 10 years of compounding at 7%. By year 20, it's closer to $4 of real purchasing power. And by year 30, somewhere in the range of 7 to 8 times your original investment. Now change one variable, and instead, imagine someone who holds the same nominal dollar amount in cash over that same 30-year period. Assuming the same 3% inflation, by year 10, they've lost roughly a quarter of their purchasing power without doing anything at all. By year 20, they've lost around half of their real purchasing power, and the inaction has a cost that compounds just like the gains do. But here's the wrinkle that matters most. And it's the one that separates the math from the actual human experience of investing. The person in the scenario only gets that outcome if they hold through the crashes. And crashes feel very different from the outside than they do from the inside. The 2008 decline was roughly 37%, and the 2000 through 2002 decline was close to 50% peak to trough. If someone invested in 2007 and sold in 2009 because they couldn't stomach the loss, they didn't get the long-run return. They got the loss, and the math of always goes up only pays out to the investor who doesn't exit when it feels most rational to do so. That's a behavioral challenge, not an analytical one, and it's the hardest part of the entire equation by a significant margin. This is why time horizon is the variable that most changes what always goes up actually means for any individual investor in any real situation. For someone with 30 years ahead of them, the historical record is genuinely reassuring in a way that deserves to be taken seriously. For someone who needs the money in 3 years, it's a fundamentally different conversation because the market doesn't care about your timeline. Now, let's steelman the part of this story that doesn't get told often enough, because it's a legitimate and important counterargument. The 10% nominal return, the reconstituting index, the compounding dividends, all of that is the U.S. story. And the U.S. may be the exceptional case. A Wharton School research paper examined stock market history across many countries and found that the U.S. has been an unusually fortunate draw from possible national economic outcomes. Russia's stock market was effectively wiped out in 1917 when the government confiscated financial assets from its citizens, with no recovery possible. The Japanese Nikkei index peaked in December of 1989 and spent more than 3 decades below that level, which is not a brief correction. That's a lost generation of returns in the second largest economy in the world at the time, and it's a fact worth holding on to. MSCI research has also documented that the relationship between GDP growth and stock market returns is not straightforward, and China is the clearest example. China has experienced some of the fastest economic growth in modern history, yet its stock market has delivered disappointing returns to investors over many of those same years. The reason involves several structural factors, including index composition, share issuance that dilutes existing shareholders, and the gap between aggregate economic activity and per-share earnings. Macro growth is not the same as market return,
And they rhyme sometimes and diverge other times in ways that matter for real investors.
The survivorship bias critique of the U.S. historical record is real and worth sitting with, not as a reason to panic, but as a reason to stay honest. We study U.S. market history partly because U.S. markets survived and thrived, and we have less rigorous long-run data for the markets that didn't survive. A naive reading of the data says the market always goes up, and a more careful reading says this particular market, under these particular conditions, has trended upward consistently. That's still meaningful and still worth understanding, but it's a different and more honest sentence than the bumper sticker version most people carry around.
And there's a forward-looking version of this argument too, which Damodaran's own valuation work consistently surfaces for anyone paying attention.
When price-to-earnings ratios are elevated relative to historical norms, expected returns over the next decade have historically been lower than the long-run average. Not negative necessarily, but lower. And the past is a real guide that just doesn't come with a guarantee the next 30 years will match the last 100. Here's what actually changed when you looked at the math, and it's worth naming clearly before we close. Always Goes Up started as a bumper sticker and turned into something more useful, which is a conditional truth with real mechanisms underneath it and real limits around the edges. The mechanisms are corporate earnings growth, reinvested dividends, and the continuous self-renewal of a diversified index that removes failures and replaces them with survivors over time. Those are structural forces and not accidents, and they're worth understanding and worth respecting as you think about your own long-term financial decisions. The limits are also real because individual stocks don't reconstitute. And other countries' markets don't have the same track record as the US. Starting valuation matters for what you'll actually earn in the next decade, and the investor who sells at the bottom doesn't collect the long-run average. They collect the pain without the recovery, and that outcome is determined by behavior far more than by the underlying math of the market itself. The durable insight is this: long-term equity returns are not magic. And they are not guaranteed, but they are also not random or arbitrary. They're the historical output of businesses creating real economic value, filtered through an index that continuously replaces losers with survivors and compounded over decades through reinvestment. And that process is only available to investors who stay in long enough for the math to actually work in their favor. So the question worth asking yourself next time someone tells you the market always goes up, or next time you're tempted to sell because the news is terrifying, is not whether that's true or false. The question is, under what conditions is that true for me, given my timeline, my diversification, and my ability to hold when it's hardest to hold? If you've been thinking about the behavioral side of this, meaning why investors make the decisions they do under pressure, that thread goes deeper than most people expect. And if this kind of careful, evidence-first look at how money actually works is useful to you, sticking around costs nothing, and neither does the next video.